In episode 1, we are going to talk about liquidity, what liquidity is, how it works, and how you can identify it on your charts. So let's get straight into it. So, what exactly is liquidity? To understand liquidity, you first need to understand one basic rule of the market. For every buyer, there must be a seller. A buy order cannot exist unless someone else is willing to sell on the other side. This also means that for every winning trade, there is someone on the opposite side of that trade taking a loss. That's simply how markets function. Now here's the important part. Every time a trader gets stopped out of a position, that loss becomes liquidity in the market. This idea is extremely important for what we're going to talk about later. For retail traders like us, liquidity isn't really a problem. We're trading relatively small position sizes, so our orders can be filled easily. But for large financial institutions, liquidity is a very big problem. These institutions are trading with millions, sometimes billions of dollars. If they want to place a large buy order, they need an equally large sell order on the other side. And finding someone willing to sell that much at the exact same price is very rare. So how do they solve this problem? They need the market to create liquidity for them. And that liquidity usually comes from traders getting stopped out of their positions. When stops are triggered, those orders provide the volume needed for institutions to enter or exit their trades. This is why price often moves toward obvious levels where stops are likely resting. Those areas are where liquidity is concentrated, and that's where large players can execute their orders efficiently. Now let's take a look at what this actually looks like on the charts. So now let's look at how this actually shows up on the charts. When you look at this price action, the first thing most people think is that the market is in an uptrend. Price is making higher highs and higher lows, and once again it looks like it's pushing higher. So naturally, a lot of traders decide to enter a buy somewhere around this area. And what's the very first thing most traders do after entering a buy? They place their stop loss right below the most recent swing low. Now let's think about what's happening on the other side of the market. Large institutions also want to buy here, but they need a lot of sellers in order to fill those buy orders. And right below that swing low, there's already a lot of liquidity waiting. You have stop losses from traders who are currently long, and at the same time, you also have sell stop orders from traders who are trying to catch a breakdown or reversal if price moves below that low. So in that one area, you have two types of orders stacked together. You have long traders' stop losses, and you have sellers waiting to enter short. That creates a pool of liquidity. What happens next is not random. Price is pushed lower into that area, triggering all of those stop losses and sell stops. Long traders get stopped out, sellers get activated, and all of those orders provide the liquidity needed for larger players to enter their positions. Once that liquidity is taken, price no longer needs to stay there. With enough orders filled, price can now move aggressively in the opposite direction. And that's why you often see price shoot higher very quickly after this type of move. This is what we call a liquidity sweep. Price dips below an obvious level, collects the liquidity resting there, and then uses that fuel to continue moving in the original direction. That's why learning to identify these areas is so important. If you don't understand where liquidity is resting, you'll often find yourself on the wrong side of the move, right before price takes off. Now, put very simply, liquidity is made up of pending buy orders, pending sell orders, and stop loss orders. So the next question becomes, how do you actually spot liquidity when you're trading? That's where the idea of liquidity zones comes in. Liquidity zones are areas on the chart where a large number of orders are likely resting and where institutional activity may have taken place in the past. As traders, our job isn't to predict the market. Our job is to follow the footprints of large institutions, because they are the ones capable of creating significant moves in price. If we want to trade alongside those moves, instead of getting caught on the wrong side of them, we need to understand where liquidity is building and where price is likely to seek it. There are a few common places where liquidity tends to accumulate. These include equal highs and equal lows, clear swing highs and swing lows, and areas of low resistance liquidity. Low resistance liquidity refers to zones where price has previously moved very quickly with little opposition. These areas often attract price again because there are fewer opposing orders, allowing price to travel efficiently. When you start observing these liquidity zones, you'll realize something important. Most of these areas are exactly what retail traders naturally focus on. That's why they matter. That's where orders stack up, and that's where price is most likely to react. Understanding this is a major step toward trading with the market instead of fighting against it. Right? So retail traders are looking at these same areas on the chart, and they're placing their buy and sell orders based on what they see forming in price. And that's exactly why these areas matter so much. These orders haven't been filled yet, which means they're sitting in the market as pending orders, and that's what creates liquidity. Let's break this down step by step. If you look at equal highs and equal lows, these are areas where price attempted to take a previous high or low but failed. When retail traders see this kind of structure, many of them will look to enter a sell position right after price forms equal highs. Once they enter those sell trades, they usually place their stop loss just above the highs. That immediately creates liquidity above the structure. At the same time, you also have breakout traders. These traders are waiting to buy if price breaks above those equal highs, so they place pending buy orders above the same level. So now, in that one zone, you have multiple types of orders stacked together. You have stop losses from sellers, and you have buy stop orders from breakout traders. All of these orders combined form a liquidity zone. Now, if there isn't enough liquidity for price to continue moving in its original direction, what can happen is price gets pushed into that zone. It moves up, triggers all those buy orders and stop losses, and clears out that liquidity. Once those orders are filled, price suddenly has enough fuel to move. And after that liquidity is taken, price can reverse and continue in the direction it originally wanted to go. That move into the highs is what we call a liquidity sweep. Price moves into the zone, collects the liquidity, and then uses that energy to continue the larger move. This is why these areas are so important to recognize. They show you where the market is likely to hunt orders before making its real move. Next, we have swing highs and swing lows. We already know that in an uptrend, price forms higher highs and higher lows, and in a downtrend, price forms lower highs and lower lows. Around these swing points, you'll always find stop losses and pending buy or sell orders. Once again, that means liquidity is present around these areas. Now let's look at this scenario. Here, price makes an upward move, then pulls back, and then pushes higher again to form a new higher high. After that, price starts moving lower and eventually breaks below the most recent higher low. When this happens, it tells us something important. It suggests that the uptrend we were in may be starting to weaken or potentially shift. At this point, price usually doesn't just continue dropping straight down. Most of the time, there isn't enough liquidity for price to keep moving lower without first retracing. And that's why retracements are necessary. What price is likely to do next is retrace back upward into an area where liquidity is resting. This retracement often creates a lower high. That lower high forms because price needs to gather more liquidity before it can continue pushing lower. So price pulls back into this zone, takes liquidity around that area, and then resumes the move downward with more strength. The same logic applies in a bearish scenario as well. Price needs liquidity to move, and swing highs and lows are some of the most common places where that liquidity is found. Understanding this behavior helps you anticipate where price is likely to retrace and where the next move is more likely to begin. Now let's talk about low resistance liquidity. Low resistance liquidity usually forms when you have multiple highs or multiple lows stacked closely together within a trend. These stacked highs or lows tell us that price has repeatedly reacted in the same area, but hasn't been able to fully break through yet. Because of this, liquidity starts building in that zone. You have stop losses, pending orders, and resting liquidity clustered around those levels. Since price has already traded there multiple times, there's very little resistance left in that area. When price eventually returns to this zone, it can move through it very easily. That's why it's called low resistance liquidity. Price doesn't struggle there, it flows through it. Most of the time, price will move to the nearest stacked highs or lows, Tap into the lowest or highest point of that zone, take the liquidity resting there, and then continue moving in the original direction of the trend. This is why these areas are important. They often act as magnets for price and provide clean targets or reaction zones within a trend. Now let's see what types of liquidity we have. Basically, there are three types of liquidity: session-based liquidity, significant swing highs and lows, and previous day high and previous day low. In the next episodes, we will dive deeper into each of them, and I will show you how to use them.